We hear it night after night.
800,000 Australian borrowers running into a mortgage cliff.
The end of the fixed rate period is coming for many Australians. As the clock ticks down, the threat of skyrocketing repayments grows.
This has been the worst I've ever seen it, and I've been in it nearly 15 years now.
This is the fixed rate cliff, and it's about to reshape your financial landscape. Australian households are facing financial challenges unlike any in recent memory. It's a double-edged sword, skyrocketing mortgage repayments and the highest cost of living pressures in 4 decades. From May 2022 to June 2023, the cash rate surged by 4% and was raised 11 times, a pace of increase not seen since the 1980s. Inflation too has soared, peaking at 8.4% in December 2022, a level not seen since the 1970s. For many, this burden is already heavy, but there's more to come. Millions of homeowners have been shielded by the billions of fixed-rate mortgages taken out during the height of the COVID-19 pandemic. But that shield is about to shatter. Banking professionals and financial commentators have dubbed this the fixed-rate cliff, when a household's fixed rates revert to variable, causing their home loan repayments to jump by 40% or more. This looming crisis raises important questions. Could the fixed rate cliff trigger a recession as households tighten their belts? Could it collapse the property market, leading to forced sales and financial instability? The RBA, as the steward of Australia's economic stability, is certainly watching. To understand the causes of the fixed rate cliff, we need to go back to the beginning.
China has identified the cause of the
Mysterious new virus.
coronavirus.
There are fears a rapidly spreading virus has reached Australia.
The onset of the COVID-19 pandemic and even the global financial crisis. While mask wearing and social distancing may seem like distant memories, the economic scars are still fresh. So it's March 2020, and the headlines surrounding us spoke of thousands hospitalised, hundreds of thousands dead, and unemployment rates of 10% or more. It was a health crisis not seen since the Spanish flu, and an economic crisis echoing the Great Depression. But this time, it was different. Unbound by the gold standard and armed with flexible monetary policy, international governments responded to the uncertainties of the COVID-19 pandemic with unprecedented monetary stimulus. The rallying cry was whatever it takes.
Today I announce that we are committing $130 billion over the next 6 months to support the jobs and livelihoods of what we anticipate of being almost 6 million Australians.
In Australia, the federal government spent over $100 billion on initiatives like JobKeeper, JobSeeker, and the Cash Flow Boost, taking on $350 billion of government gross debt over the pandemic period. This was an environment of already low interest rates following the excesses of the global financial crisis.
Australian government debt has jumped to nearly 25% of the country's GDP.
Economists and the opposition are rubbishing an attempt to blame the Reserve Bank for Victoria's mounting debt.
The RBA had its own part to play too in propping up the economy with 3 key initiatives. First, the cash rate was slashed to a record low of 0.1%, a rate never seen before. Second, the RBA began a yield targeting and bond buying program to maintain expectations that rates would remain low at 0.1% in the midterm. RBA Governor Philip Lowe even provided forward guidance that interest rates would remain at 0.1% at least until 2024, a prediction he would later have to retract and apologise for.
For most of the past 2 years, we thought that growth would be slow to recover, the inflation would stay fairly low, that there'd be a long tail from the pandemic. And given that, we thought interest rates would need to stay where they were until 2024.
Third, the RBA set up an initiative known as the Term Funding Facility. This allowed authorised deposit-taking institutions, which are essentially banks, to borrow from the RBA at ultra-cheap rates of 0.1% for a period of 3 years. But the intention with these funds was to lend a helping hand to small business owners who were trying to survive back-to-back lockdowns.
Good evening. South Australia is tonight a state in lockdown.
Melbourne's war on COVID has hit fresh grim milestones, marking both 200 days in hard lockdowns.
A giant padlock is about to snap shut on Sydney and the rest of the state.
What happened instead was that most of the credit ended up going to residential mortgages. Another thing to note here is that most banks decided not to offer the same record low discounts to variable rate loans, because variable rate mortgages make up most of a bank's portfolio, and any further discounts would have negatively impacted their profitability. So the strategy was to use ultra low fixed rates instead to attract new customers and lock in existing ones, preventing them from jumping ship. And that's what signaled the rate pricing wars we saw over the course of 2021. Banks were in fierce competition, slashing their fixed rates to unprecedented lows, trying to outdo each other. This was starting to look like a game of cat and mouse, with banks adjusting their rates in response to what others were offering.
8 lenders on the Rate City database have cut at least one fixed rate in the past week. Westpac, CBA, First Mac, Loans.com.au, Macquarie Bank, Suncorp, Homestar Finance, Investment Loans and Athena Home Loans.
And as if cheap rates were not enough, low rates were complemented by extraordinary refinance rebates from major banks like Westpac and ANZ and challenger banks like Citibank and Suncorp, further adding fuel to the fixed rate fire. So what happened next? Fixed rates shot up from about 15% to 46% of all new home lending by July 2021. Of the $2.1 trillion home loan market, 35% or $735 billion was fixed as at January 2023. 65% or $400 billion of these fixed rate loans are now due to roll into variable rates by the end of 2023, which means many loans with rates below 2% revert to at least 6% if they haven't already. And as the last of the Term Funding Facility funds were drawn down by banks in June 2021, we are now at the highest point of the fixed rate cliff. So, most fixed rate loans will expire in July 2023, with the balance reverting to variable over the remainder of 2023 and into 2024.
Thousands of Queensland families are currently dangling off a mortgage cliff.
Mortgage brokers are being swamped with anxious borrowers trying to find better deals.
So, what does the fixed rate cliff mean for everyday Australians?
Pulling kids out of private school and even just going, how are we actually going to pay for the groceries every week?
Well, at the household level, it's a direct hit to personal budgets. Many households will face a sizable step up in mortgage repayments as 12 months or more of rate increases are felt all at once. For example, a household with a $1 million principal and interest owner-occupied mortgage and a 2-year fixed rate of, say, 1.94% in March 2021 would have seen their repayments rise from $4,209 to $6,064, an increase of over 40%. That's a significant hit to surplus cash flow for any household. Now, at a macro level, the jury is still out on the degree of impact to the economy and house prices. On one hand, we're expecting a significant economic slowdown, and there's likely to be some shock to household spending. In fact, Bloomberg Intelligence suggests that the fixed rate cliff could reduce retail sales by $9 billion or 2.2 percentage points of 2022 calendar year sales. And KPMG estimates the impact to overall household consumption to be around $20 billion lower over 2023, with 1% being shaved off GDP. And what's adding fuel to these predictions of a slower economy? Well, it's the fact that fixed rate loans have some characteristics that make them riskier than their variable counterparts. According to the RBA, these loans tend to have higher balances relative to borrower incomes, higher loan-to-value ratios, and they're often newer loans. This has led to the emergence of what's being called mortgage prisoners. These are people who are stuck with their existing lender. And the reason why is that many of these fixed rate borrowers took out their loans at a time when the assessment rate applied by their bank was in the realm of 5 to 6%. This assessment rate is the interest rate that the bank tests you on to decide if you are eligible for a loan, not the rate they expect you to actually pay. so it includes a 3% buffer that's added to your actual rate to prepare you for times like these. But here's the problem.
The Reserve Bank will hand down its monthly decision on interest rates.
By December 2022, we had experienced the 8th consecutive rate rise since May 2022, and that 3% buffer had essentially been reached. So this meant that a large chunk of fixed-rate mortgage holders would have been put in a position where they can theoretically no longer afford their current loan, and hence are also stuck with their current lender.
It's not like wages have been keeping up with the inflation or these interest rate hikes. So this is now starting to get to the point where we're really seeing bone on bone for households. A lot of them are going to be wondering how they're going to make this Christmas happen.
Now, if we look at the other side of the macro debate, you have economists who believe that the impact on the economy would not be as severe. And that's because the RBA has done a lot of research around the resilience of the Australian housing market, and in particular, household savings buffers. A lot of argument is around the fact that while fixed rate loans are indeed riskier, the difference in risk compared to variable loans isn't that large. And this is because of 4 reasons. Number 1, most fixed rate borrowers made significant prepayments before their loans were even fixed. Number 2, a lot of these loans also have a variable split where the bulk of savings are actually held, and these amounts are similar to 100% variable rate holders. Number 3, many fixed rate borrowers keep their savings in non-mortgage based products. So when fixed rates expire, this money is often immediately used to pay down or offset previously fixed home loans. And number 4, these borrowers would have at least made some preparations for when their fixed rates were set to expire. Another thing to add is that the RBA has argued that the mortgage market is fiercely competitive. So at least 1/3 of fixed rate borrowers have been able to negotiate a better variable rate with their existing bank. And those who successfully refinance have also received attractive cash rebates. So what's the overall picture here? While the fixed rate cliff will undoubtedly have a negative impact on the economy and house prices, it won't be the sole driver of financial instability. And here's why. Despite rising interest rates, home loan defaults are still extremely low. Sure, banks like Westpac are starting to field more hardship calls, but the percentage of high LVR households isn't currently a source of concern. Plus, households in general have large savings buffers and their personal balance sheets remain strong. The combination of these factors means that there is unlikely to be a massive sell-off in the property market caused by the fixed rate cliff alone. So, what does this all mean for households and the economy? Well, this is happening to every household and every lender. You're not alone in this, but it does mean that there's nowhere to hide and the era of historically cheap money is well behind us. Looking ahead, we're set to enter a season of uncertainty and discomfort, especially for lower income households, first home buyers, and homeowners who bought at the top of the market during the mid-pandemic liquidity boom. To navigate this time ahead, you have to be proactive. You need to move the levers within your control to boost cash flow and create savings buffers, either by increasing income or lowering expenditures. And for the savvy investors or households who've been waiting on the sidelines, watching interest rates go up, there may actually be some buying opportunities. So now, more than ever, you must keep an eye on the economic data and understand the movements of the RBA and the Australian banks. In terms of where we stand right now, most economists predict the cash rate to hit 4.85% by the end of 2023, which means you can expect your principal and interest home loan rates to hit around 6.5% and interest-only rates comfortably with a 7 in front. So how can you manage this jump? To be very practical about this, we've split our responses into 5 courses of action. These are negotiating with your current lender, exploring basic and advanced refinancing strategies, proactive budgeting and income generation, and what to do if you're experiencing financial distress. We'll start with negotiating with your current lender, which is the quickest and easiest way to lower the cost of your home loan once it switches to variable. It may surprise you, but most lenders will be willing to shave off up to 0.5% from your default variable rate, simply because they don't want to lose you as a client. And if we're talking about a $1 million loan, you're probably looking at a jump from a fixed rate of 1.95% to 6.5% variable, which translates to a $2,476 increase in repayments. But if you can negotiate that variable rate to 6%, you could take repayments down to $5,844 from $6,147, saving you $303 per month. I know that doesn't seem like a lot, but it's a saving you could achieve just from a simple phone call or email. It may also be the only step you can take if you don't pass the serviceability requirements to refinance. If you are able to refinance, that would be your next course of action, with the most basic of switches being what brokers call a dollar-for-dollar refinancing. This is where a loan is switched over to a new lender for the same loan amount, for the same remaining loan term, and for the same repayment type. So the main goal with this strategy is to solely achieve a better interest rate and reduce your interest costs. And in some circumstances, refinancing may help you achieve more meaningful savings than with rate negotiation alone. If I refer back to the previous example, in evaluating refinance opportunities, we typically aim for a further rate saving of at least another 0.2%. This is something a rate negotiation alone cannot achieve. As you can see here, we were able to bring the rate down from the negotiated 6% to 5.8%. Just keep in mind that there are costs involved with refinancing, so you need to make sure that the rate savings outweigh the transaction costs. You also need to personally weigh up whether the savings are worth the inconvenience of moving your personal banking, which involves setting up new accounts, applying for new cards, and instructing new direct debits. The third course of action involves more advanced refinancing strategies and will generally benefit people who need to dramatically boost their cash flow, not just lower costs, and especially those with a portfolio of loans. But these strategies are a little more complex than dollar-to-dollar refinancing because they involve restructuring the repayment type and potentially shuffling things around with your loans. Now, the steepest rate shocks would hit those rolling from fixed interest only to variable principal and interest loans. Usually, investors will set up fixed interest only repayments in the initial stages of their loans because it allows them to maximize their tax deductible debt while paying down their owner occupied loan as fast as possible, which is not tax deductible. We can see the impact of the cliff in these types of situations is much more dramatic. If the interest rate goes up from 2.49% fixed to 6.6% variable, and repayments go from interest only to principal and interest, repayments increase from $2,075 to $6,535. The only way to mitigate this is to refinance the loan back to interest only, reducing the repayment shock to $5,333 per month. But this is still a 1.5 times increase to the previous fixed rate repayment. The other option would be to keep the loan on a principal and interest repayment, but to re-extend the loan term to 30 years. In this case, repayments would go to $6,060. The repayments are still high, but definitely more manageable. Now, moving on to the fourth course of action, which would be applicable in any of the three strategies we just mentioned, and that's proactive budgeting and income generation. With the prospect of recession around the corner, households need to look at how they can boost their cash flow and, where possible, create savings buffers. There are two sides of the equation. How can you increase your income? And how can you cut your expenditures? On the income side, ask yourself, can you work more hours? Take on a second job or a side hustle? Earn a promotion or switch to performance-based income? Maybe you can rent out a spare room in your house or convert eligible properties to short-term rentals. On the expenditure side, it's time to take a hard look at your spending. Are you using credit cards beyond your means? Can you stretch the life of your possessions or buy second-hand? Can you cut back on discretionary expenses like eating out, holidays, or unused subscriptions? Maybe it's time to consider public schools for your kids or renting out your home and living somewhere cheaper. Remember, every little bit helps. Boosting your income and cutting back on expenses might just be the trick to get you out of mortgage jail if you are struggling to refinance. Now, let's talk about the reality that some households may face. For some, the shock of transitioning from fixed to a variable rate will be just too much. This is particularly true for lower income households with higher loan-to-value ratios and newer mortgages. They simply haven't had enough time to build up savings and equity buffers to weather a period of higher repayments. And of course, this could apply to anyone, not just those on lower income levels. Sometimes life throws us curveballs that are beyond our control. The death or illness of a primary income earner, job loss, or having to care for a sick family member can all drastically impact household cash flow. So, our fifth set of actions is for those already experiencing or preempting financial distress. In these situations, the choices are tough but clear. You could firstly call a bank's hardship line or speak to your banker about setting up a financial arrangement. For example, making partial loan repayments or at least paying the interest of a loan can buy you some time. Another option could be selling property or assets. This is a last resort, but it's something that lenders may enforce if you default on a secured loan and show an inability to repay. For business owners, switching from a bank to a non-bank or a private lender may help you achieve more runway. You could also switch loans to interest only or have interest capitalized to preserve your cash flow while you trade out of the downturn or undertake a measured sale of assets. In all these situations, it's crucial to seek help early before you run out of cash or are forced to sell a property on terms you cannot control. The National Debt Helpline and the Mob Strong Debt Helpline are great resources for free advice. And remember, you're not alone in this. There are resources and strategies available to help you navigate these challenging times. So, here are my final thoughts on all of this. There's no doubt that the shock from the fixed rate cliff will shape Australia's macroeconomic landscape over the next few years, impacting household budgets, property prices, and economic stability as a whole. And so, you're going to have to find ways to manage the impact, be it through negotiating on your loans, refinancing, boosting income, or cutting expenses. But I don't think that the mass expiry of fixed rate loans is going to destabilize the economy and be a sole driver of a recession. Nor is the fixed rate cliff going to crash the housing market. So, I'm confident that our clients and followers will have the resilience, creativity, and street smarts to come out on the other side more financially savvy and prosperous than ever. Thanks for watching. If you enjoyed this video, make sure to subscribe to our channel and follow SF Capital on our socials to stay in the loop on all things finance. See you next time.